President Trump just signed an executive order that may dramatically change your retirement account. So, in today's episode, I'm going to explain the change, what it could mean for your 401k, and the benefits and the pitfalls that you need to know. But first, my name is Kevin Lum. I'm a certified financial planner, and this channel is dedicated to helping a million people retire without worry. So, I want to start by talking about the specific changes, and then I want to zoom out a bit and talk about alternative assets, specifically private credit and private equity. So even if you don't have a 401k, I'd encourage you to stick to the end or go ahead and skip ahead where I talk about the broader asset classes. Because even if you haven't heard about these asset classes today, I guarantee you are going to hear about them over the next few years. So first, what changed? There were two big moves over the past few months. On May 28th, 2025, the Department of Labor rescinded its 2022 warning that told plan fiduciaries, so the fiduciary of 401k plans or retirement plans, to use extreme care with crypto in 401ks. Now we are back to, we could say, neutral. Fiduciaries must still be prudent with the investments in the plan, but crypto is no longer singled out. Then on August 7th, 2025, a White House executive order told the Department of Labor, the Treasury, and the SEC to facilitate access to alternative assets and 401ks. This includes things like private credit, private equity, real assets, and digital assets. And more interestingly, they also told them to explore safe harbors so employers aren't paralyzed by litigation risk. For example, you could put private equity in a 401k plan today, but it really opens up the employer to risk of litigation. And so what you need is some sort of safe harbor rule to say, look, if you put private equity or one of these alternative assets, say Bitcoin, inside of the 401k as an option, you are going to be at risk of litigation for that choice. Now, I need to be clear. This does not force your 401k plan to add alternative assets, but it changes the tone and helps open the door for more plans to be able to adopt alternative assets inside of your retirement plan. Context matters. In 2020, the DOL said that you could use some alternative assets inside of diversified funds like a target date fund. Then in 2021, they urged caution. Well, you can use them, but be careful. On August 12th of this year, 2025, at least of this recording, that caution was rescinded. Now, it's not likely you're going to see a ton of direct access. Most likely, most of you will see target date funds that have some alternative assets inside of it. As you know, a target date fund is the default in a lot of 401k plans. Essentially, you choose like 2065, and then the fund chooses the split between stocks and bonds. And as you begin to age, it begins to de-risk. But basically, you just invest in one fund, and then that fund takes care of all the investing for you. Now, I am not a huge fan of target date funds, but they serve their purpose. And I think this is where we will first see alternative assets is inside of a target date fund, because the fund manager can control the risk. The other thing I think you're going to see is a number of alt funds, right? You might see a private credit sleeve or a digital asset fund. Maybe you'll see a Bitcoin fund, but as a general rule, you'll probably see some sort of blended fund that tries to diversify the risk. And then some plans, and many plans already have this, will have some sort of self-directed brokerage option. At Fidelity, it's called Brokerage Link. So with the Brokerage Link or with self-directed brokerage, you have a ton of options and aren't limited by the options inside of your 401k plan. So let's say you're really excited about this. You're like, I have been waiting for alternative assets. I want to invest in private credit or private equity, or I've been waiting to invest in Bitcoin. I know a few of you, I've seen you in the comments. I know you've been waiting for this. You were excited about being able to invest in Bitcoin or Ethereum or whatever coin you are into. You're excited and you're like, when am I going to be able to do this? When will we actually see these changes? Unfortunately, these type of changes, they take some time. First, we get a ruling from the federal government. And then employers typically move pretty slowly to implement them, partially because of the fiduciary standards. So my guess is you might see something in maybe a year at the earliest. You got to have time for the record keepers to make their changes, and then for, maybe an investment committee to evaluate these options and look at the fees and what's available, and then a few months to implement. I think it might be a year to maybe up to 3 years before you start seeing alternative assets, even if they do get adopted inside of your work 401k plan. In short, don't expect Bitcoin in your 401k next quarter, maybe in 2027. Now I want to pull back a bit and I want to talk about these asset classes more generally. We're seeing these changes for a couple of reasons. One of the reasons we're seeing particularly crypto added to these plans, or the push towards crypto, is the Trump administration has been very pro crypto. But also you're hearing a lot of employees say, look, I want to be able to invest part of my 401k, my retirement plan, in alternative assets like crypto. And as Bitcoin becomes a larger and larger piece of the market, it might in fact make sense to be able to have access to this very large asset class inside of your 401k if you want to invest in it. But the other reason we're seeing this push towards alternative assets is it's not being driven by Main Street, right? Bitcoin is being driven more by retail people. But Wall Street is really pushing for access to your 401k or your retirement plan because it is big business. Financial firms are pushing these assets hard, and they are flush with cash, and they are spending big money to win shelf space. And the pitch is going something like this, right? There are fewer public companies, which is true. There are dramatically fewer companies today than there were 30 years ago. Higher returns are in the private markets. That is partially true as well. The other pitch is, well, it provides diversification, and also companies are staying private much longer, meaning that much of the value is being captured in the private markets and not in the public markets. But of course, like I said, the fine print is that first of all, the fees are significantly higher and private markets are much less opaque, right? I'm not talking about crypto or Bitcoin. You could say, well, that is all on the blockchain so you can see what's happening. But I'm specifically talking about private credit and private equity. There's much less transparency in the private markets, right? Public markets are public. You know everything about that company, everything about what they're going to do. And there's all these rules about how they release their financials and insider trading and all that. Well, private companies do not have the same restrictions. So you have much higher fees, and you also have a lot less transparency. But a lot of times the pitch is these assets have lower volatility, but it's simply because they aren't being marked to market. And so what ends up happening is salespeople from these firms overstate the lack of volatility, and they overstate the diversification. When you unsmooth the returns, I don't know if that's a word, but when you actually dig down into the actual numbers and you look more closely, you notice that there is much higher volatility than what the sales decks say. And there's also a much higher correlation with equities markets than is pitched to you. So here's how I want to end. Am I anti-alt? No, not at all. Not anti-crypto, not anti-Bitcoin or Ethereum. I'm not against private credit or VC or PE. I share the concerns that drive a lot of this, that companies are staying private longer and the spoils aren't being shared evenly. I mean, look at OpenAI and SpaceX. They're both private companies with valuations in the hundreds of billions of dollars, and most of us can't get in. Meanwhile, in an earlier era, the great companies went public much earlier. Microsoft, Amazon, both of them had valuations of under $1 billion when they went public. And so we could share in the riches through our 401k. As those companies did better, as NVIDIA did better, and Microsoft did better, and Amazon did better, we were able to participate in the growth. But as we're seeing now with OpenAI and SpaceX and some of the other really innovative companies, is they are hitting valuations of $400 and $500 billion while they're still private, meaning that only the wealthy are getting to take part in those riches or that wealth. And so I understand and I'm sympathetic, right? There's definitely a case for opening up particularly venture capital to a broader market, or at least having these companies go public earlier. But my fear is that we're not going to get in on the good stuff, and that we're going to be sold junk at really high fees that is going to end up ruining any returns that we're getting. Because like I said, Wall Street is hunting for new fee pools, and your 401k is the biggest pool around. So let me wrap this up. I don't care if you add a little bit of crypto to your, 401k or maybe a little bit of private equity. I might even join you. But I would size both very small. I'd recommend no more than 3 to 5% unless you are a very sophisticated investor and can stomach real drawdowns or maybe it all being wiped out. Here's my simple playbook. Start with your core investments. Have a diversified, broadly diversified portfolio for most of your assets. Right? Get low cost access to the broader market. 2, know the fees, know what you're paying, understand all the cost and the performance fees and the platform wraps and all the different ways that you can be charged fees. Know the fees. Then know the lockups and the valuation policy. If they claim it never goes down and it's this magical money-making machine, that's a red flag. And then, like I said, no matter how you invest, right, keep your sizing small. Hey, thanks for watching this video that went on a bit too long and maybe a bit too in-depth. And for the one person who's still watching, which I don't know if there's one person left here. Thank you, and I hope this was helpful. And if you are watching this because you're like, I just want to know if I can retire, and I heard you're the retirement guy, I got a whole playlist of videos that can help you understand how you're doing on your journey towards retirement.